Welcome back to this 4-episode series on recession investment. So if you keep closely with all the content that I'm currently sharing with you guys, you can be sure to thank me when the market has already recovered. Okay, so if you have not watched the previous episode on value investing, Warren Buffett's favorite, please be sure to watch it before you watch this video. If not, you will not understand what I'm talking about. Okay, so this is portfolio investment. Portfolio investment are for people who want to put in most of their assets. Do you know when we heard here of the term millionaire or billionaire? We imagine that they have $1 million or even $1 billion in cash in their bank, but this is not how it actually works. So how does it actually work in the real life? Okay, so let me share this with you. In a game of soccer, have you ever thought, what is the objective of soccer? Not to let your opponent score against you, am I right? Okay, so why are there no 11 goalkeepers in any soccer team? And then you will be saying, because they will need to score goal as well. Then why don't they put 11 strikers in a team? 11 Ronaldo or 11 Messi? Okay, because that's not how it works in real life. In real life, you need a good team, of goalkeeper, defenders, midfielders, and strikers. Okay, so generally this is how a diversified portfolio looks like. One goalkeeper, which is about 8 to 10% of your asset, should be held in cash. So the cash portion should be about 6 months of your pay if you're currently employed, up to maybe about 1 year of your pay. Okay, alternative to cash, would be God's money, according to Robert Kiyosaki, gold. Okay, gold is a currency, you can use it all around the world because it's worldly recognized. You can go to Zimbabwe, you can go to Switzerland, you can go to any place in the world, they will accept gold as a currency. But of course, you don't buy sweets with gold. But you get what I'm saying. Okay, so generally, 8 to 10% in cash. About 30 to 40%, will be in bonds. As I mentioned in my previous video, bonds are the defenders. These are the defensive strategies. They don't have much fluctuation. They do not have a 200-300% growth, in a very short span of time, but yet they still pay certain dividends and they are very, very stable. Okay, so this is why you need bonds for about 40% of your asset as bonds as your defenders. Moving forward to the midfielders. Midfielders, you want to put into somewhere where it's more diversified. Okay, so more diversified meaning that you can, with the same price, buy more companies because your risk will be spread out. Okay, so usually people will put about 30% of their money into ETFs and mutual funds. Okay, so what's the difference between mutual funds and ETFs? Okay, a quick one. ETFs, they basically track certain indexes. Similarly to like the previous video I mentioned, S&P 500, Dow Jones, they are indexes. So basically, they are a marker, of how well the top 30 companies in the whole world is doing, how well the top 500 companies in the whole world are doing. So basically, they just track. Okay, mutual funds, they are created by fund managers. So fund managers, they will actually charge you a management fee, and then they manage the portfolio. So when they think that this particular stock, is lousy, okay, you actually sell it and buy better stocks. Okay, so this is for mutual fund and ETF. So when you invest in a mutual fund or ETF, you can expect, to be invested into 50 to 100 to a few hundred different companies. Okay, so like for example, yesterday I shared about the China fund. Okay, personally I purchased certain China fund from a mutual fund. Okay, moving forward will be the strikers. The strikers, are the stocks, generally about 20 to 30%, depending on how aggressive you are. So the stocks, will be the companies which I shared yesterday. These are the companies, or rather the stocks, are the investments, which will give you a good chance to double up your profit. But at the same time, you do not want to put everything in because it will halve your profit anytime as long as the market goes snap. Okay, so this whole entire strategy, of soccer, is a very good analogy of how you should invest your money. Okay, you must be thinking, why shouldn't I put everything in stock, or why should I put everything in cash? Okay, let me share with you, this is why. Imagine you have struck a lottery, you struck $1 million or $10 million as per se. So if you have $10 million, where would you put your money? If you put your money all in a bank, what happens is that this will happen. There's this thing called inflation, which basically means that the value of the currency of your money, reduce in value, on every year. Basically means that things will get more and more expensive over time. Okay, a plate of chicken rice costs 50 cents, maybe about 30 years ago. Now it costs about $5, I don't know, maybe $4 to $5. Okay, $4 to $5 from 50 cents. This is what happened, this is the effect of inflation. Okay, so if you put, just based on Singapore's inflation rate of maybe about 1 to 3% depending on what year, right? You are losing out $300,000 of value if you put your money in the bank. And this is why you need to do investments. This is why you need to find somebody who knows how to do investment to do investment. The person may not be me, the person may be any of the professional with a professional qualification of investment, not the aunties and uncles that you hear that, hey, you should buy this one, you should buy that one, because I think it's good, because my friend tell me it's good. Yeah, you should not do that. Okay, you should find somebody who's qualified, and those people must invest their own money, because they must burn their fingers before they know what they're talking about. Alright, so this is for portfolio investments. Generally, the risks are being contained. There's no upside, swing of 50, 60, 70%. And at the same time, there's no gains of 50, 60, 70%. These are for people who just want to beat inflation. They want to get a good 8, 10, maybe even 15% return. Okay, this is where they will park their money. Alright, so this is episode 2 of this 4-part series on investment. So in the next video, right, I will share more on dollar cost averaging. So if you follow my content closely, right, you can be sure, right, to make a lot of money when the market recovers. Alright, ciao.